open decline in interest in U.S. Treasuries. Since 2014, all central banks have been net sellers of U.S. Treasuries and net buyers of gold. Watch the direction of that hockey puck. I can't reiterate it enough. These things are not headlines for headline's sake, and they're not gold bug sensationalism. It's the movement of current history. BRICS rise is not a joke. It doesn't mean they're super powerful and Russia and China don't have problems and they're going to take over the world, that I'd rather live in Shanghai or Moscow, Los Angeles. I'm not saying that, but let's be realistic. 30 countries are repatriating their gold in their own zip codes, and why 45 nations trade outside of the US dollar, and why the UAE and Saudi Arabia are selling oil now outside the dollar, and why China is buying oil from Russia and yuan, and Russia's converting that yuan products they buy out of China and then converting it to gold, and that's selling it in gold on the Shanghai exchange. Gold is being used as a medium of exchange. It is being used as a store of value, unlike Bitcoin.
The global financial landscape is undergoing a significant transformation, with efforts to challenge the U.S. dollar's dominance gaining momentum. Key drivers include the rise of the BRICS bloc, increased reliance on gold as a strategic asset, and mounting opposition to the dollar's weaponization. The U.S. dollar has long dominated global payments and reserve systems, but recent data reveals a decline in its supremacy. In October 2024, the SWIFT payment system reported that the dollar's share of global transactions fell below 50% for the first time in recent memory, dropping to 47%. This signals a tangible shift, driven in part by the de-dollarization agenda championed by BRICS nations. Developing countries are increasingly cutting ties with the dollar, accusing the U.S. of leveraging its currency as a geopolitical tool. This sentiment has only intensified with policy proposals like Donald Trump's plan for 100% tariffs, which many in the global South view as exacerbating the dollar's weaponization. In parallel, central banks worldwide are turning to gold as a trusted reserve asset. China's central bank, the People's Bank of China, PBOC, resumed gold purchases in November 2023 after a 6-month pause. Notably, the PBOC was the world's largest official buyer of gold in 2023, reflecting a broader trend among central banks to increase gold reserves. MatthewPiepenburg highlights that BRICS nations are reducing their holdings of U.S. treasuries and embracing gold, which the Bank for International Settlements, BIS, designated as a Tier 1 reserve asset in 2023. This shift underscores diminishing confidence in fiat currencies and the dollar-dominated global financial system. The abandonment of the gold standard in 1971 fundamentally altered global finance. Piepenburg notes that since then, the purchasing power of major fiat currencies, including the dollar, has plummeted by over 98% when measured against gold. This decline reflects not gold's inherent strength, but the corrosive impact of debt and inflation on fiat currencies. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
And, since 1971, we went up the gold standard. We took that chaperone away. You know as well as anyone else that the inherent purchasing power of all the major currencies, including the world reserve currency, is lost over 98% when compared against gold. So again, gold isn't getting stronger. Debt has made currencies weaker. And that is why the BRICS have no longer trusting the U.S. Treasury as a reserve strategic asset. And that is why the Bank of International Settlements has made gold in 2023 a Tier 1 asset for storing as a strategic reserve asset, not the U.S. Treasury. Yes, the U.S. Treasury is still listed as a Tier 1 asset, but the world is moving away. The puck is moving away from U.S. Treasuries, and gold has become the asset you save in, and then you spend in fiat. So that open decline in interest in U.S. Treasuries since 2014, all central banks have been net sellers of U.S. Treasuries and net buyers of gold. Watch the direction of that hockey puck. I can't reiterate it enough. These things are not headlines for headline's sake, and they're not gold bug sensationalism. It's the movement of current history. The BRICS rise is not a joke. Doesn't mean they're super powerful and Russia and China don't have problems and they're going to take over the world, that I'd rather live in Shanghai or Moscow than New York or Los Angeles. I'm not saying that, but let's be realistic. And there's a reason why 30 countries are repatriating their gold in their own zip codes, and why 45 nations trade outside of the US dollar, and why the UAE and Saudi Arabia are selling oil now outside the dollar, and why China is buying oil from Russia and yuan, and Russia's converting that yuan into products they buy out of China and then converting it to gold, and that's selling it in gold on the Shanghai exchange. Gold is being used as a medium of exchange. It is being used as a store of value, unlike Bitcoin, in real-term ways right now, in momentous ways that the media does not want to talk about, because the media is owned, as I've written before, by 5 companies. The entire U.S. media is owned by 5 companies, 5 boards, 5 perspectives. And they lie through omission. They lie by not talking about what it means that the BIS made gold a tier 1 asset, what it means when 20% of oil is now being sold outside of the petrodollar system, what it means when the Saudis and the UAE are talking to China and the BRICS and joining the BRICS and already talking about net settling oil outside of the US dollar. These are massive, massive implications on the demand for that dollar. And again, it doesn't mean the end of the dollar. It doesn't mean the end of the world reserve currency status. It just means that weaponized dollar is trusted less, wanted less, it's demanded less, it's going to get weaker despite all the other things of the milkshake theory. And the other thing about Trump with his tariffs, well, tariffs, I understand the optics of make America great, focus on America, focus on manufacturing. Tariffs traditionally are to protect American manufacturing, American productivity. But let's not forget that in 2001, when we let China into the World Trade Organization, and we said this is going to be great because China's going to buy all our toasters and all our cars and all our tires and all our ham radios, it's going to be great for America. Let's not forget that the opposite happened. China makes all our cars, our tires, our toasters, and our radios because American companies, CEOs, offshored all that labor to cheaper labor in Asia and some parts of Central America. They fired millions of employees in America so that they could hire cheaper labor offshore. In short, the American dream is now made in China. So if you're going to have tariffs to protect American manufacturing, we're not really protecting much manufacturing. It's all offshore. And you can thank the CEOs of Apple for that. You can thank the CEOs of almost every product you buy in a Walmart because more than 90% of it is made in China, even though it has an American flag on it. That's the problem of greed in the C-suite. That's the problem of CEOs who get paid on their share prices, and they don't care to fire millions of Americans to get cheaper labor offshore. So these tariffs are going to be inflationary as well. And the real sinner isn't, I think what the tariffs can do is convince American companies who have labor overseas, who have to export things back to America, you know what, with all these tariffs, we should just bring everything back to America. And for that, I see what Trump is trying to do. And for that, I applaud him.
Gold has seen a significant surge in demand over recent years, and for good reason. Renowned for its role as a portfolio diversifier, an inflation hedge, and a safe haven asset during economic uncertainty, gold has become increasingly attractive to investors. This rising demand has driven gold prices to record highs, surpassing $2,700 by October. While its trajectory remains uncertain for December and beyond, the underlying factors influencing its value remain compelling. Silver has also gained traction, with rising prices and silver IRAs emerging as a popular alternative among investors considering precious metal IRAs. This dual demand for gold and silver has sparked a debate among investors. Which metal better fits their portfolios? MatthewPiepenburg highlights that gold's rising value is not driven by increased jewelry demand or its inherent physical qualities. Instead, the weakening purchasing power of fiat currencies, eroded by inflation and unsustainable debt, has bolstered gold's status as a reliable store of value. Silver, too, benefits from these dynamics, making both metals critical assets during periods of monetary instability. Let's get back to the interview.
Gold doesn't go higher because it's just getting nicer or there's more jewelry demand. It's because the dollar and fiat money is getting weaker. And even the idea of Bitcoin coming in to save the day, that's a desperate argument, not a future solution miracle. Again, some Bitcoin diehards would disagree with me and say, just be patient, it's coming. I don't see that. And it's not because of a bias. It's just because history confirms that the only real asset, the only real precious money, a real precious metal is gold and silver, in particular gold. And gold's only going to go higher, and to Egon's point, because fiat money is going lower. And fiat money is going lower because debt is not going to get better in the next 4 years, no matter what Trump decides to do. And it's worth talking about his laudable decisions to cut the spending with the Department of Governmental Efficiency, to cut some of the waste and the bureaucracy in D.C. But again, that's an inflationary move. You can give a lot of pink slips to the Department of Education or the Department of Agriculture and cut the fat in D.C., which certainly feels good to a lot of people who see D.C. as like a Soviet-like bureaucracy of just a lot of corrupt, lazy people doing nothing and taking a check. Okay, you can understand the optics of that, and if certainly if Vivek and Elon can do that better than anyone, they can create pink slips. Musk has shown he can do that in a lot of places. But again, that's fine. But again, all those people you're going to give pink slips to are going to go on the dole or need some other kind of support. That's going to be expensive. They're going to be unemployed probably for a long period of time. Okay, some people may not feel sorry for that, but that's still a cost. But the other thing is, if you just bring the interest rate down by 25 basis points, that saves you $25 billion in interest expense. So cutting rates will do more for dealing with our debt problem than just firing a lot of people in DC. Now, despite all the optics of cutting the fat, which I like in DC, the real faster solution is $25 billion just by cutting interest rates by 25 bips. Because you have to fire a lot of people in DC to get the equivalent of $25 billion in salaries that you're saving money on. So I think, the aim of DOGE is to cut $2 trillion in spending in the U.S. in the next 2 years, by our 250th birthday. That's a big headline, and that's great. To me, that is not going to change the fact that we're still going to have trillion-dollar deficits. We're still going to have a debt crisis. If you really want to cut spending to make an impact on inflation, you're going to have to cut entitlements in military by probably 40 to 50%. Now, if he does that, I'll rethink the inflation argument overnight, and I'll even rethink the gold price overnight.
The evolving financial environment underscores the importance of diversification and resilience in investment strategies. As the global reliance on fiat currencies faces scrutiny, gold and silver emerged as vital tools for navigating economic uncertainty. These precious metals hedge against inflation and safeguard amid shifting monetary policies and geopolitical changes. Their rising demand reflects growing concerns about the stability of traditional financial systems, reinforcing their relevance in modern portfolios. How do you view the role of gold and silver in today's changing economic landscape? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.